everyone. Welcome back to the third episode of Making Sense of Sense. Q4 is officially here, which officially means we are out of September and into a fresh month of October, also known as spooky season, which starts 3 to 4 months in advance. As I was saying last week, September is historically known as the most volatile month of the year since investors are coming back from their summer lavish vacations in the Hamptons and markets are a bit rattled. There's more transaction volume happening, natural swings with momentum trading, options trading perhaps, and that all occur in spiral due to this buying and selling spree heading into Q4, which conveniently also is a big holiday season and the largest of the year. So it's definitely a wacky time. Yet luckily markets have bounced back and actually had their best 2-day win streak for the first time. You can fact check this, first 2 days, I believe, in a while. That just happened at the start of October. Yet sadly, of course, they've come down by now. Nothing new here. So speaking of the holidays anyways, I have to try out the pumpkin spice latte, or really anything related to pumpkin spice. In fact, believe it or not, I've never had anything pumpkin spice. I know that may be a sin here in New York since everything seems to be related to cozy holiday weather and festivities. Tends to start roughly 3 months prior to the actual holiday, and pumpkin spice is a huge component of that, not to mention drives and a majority of business, at least for Starbucks during Q4. But I'll try it eventually and fill you in on the scoop. Feel free to comment below what you recommend I try first in the pumpkin spice realm. Surprisingly though, even pumpkin costs I heard are rising. I understand that McCormick as a spice maker is probably feeling the effects as a producer of all things home spice, but I wouldn't expect pumpkins as well. I have a feeling we're going to see reports of price gouging from companies these days, just like back in February, March, when oil giants such as ExxonMobil and Chevron were slamming the supply chain shock from the Russia-Ukrainian war and directly price gouging here, blaming this price gouging war in the US and hurting consumers at the pump. Only time will tell, but what's for sure is that the S&P and major indexes will not rebound until the Fed has announced inflation has peaked, most likely. In the meantime, this is the best time to not only deploy your cash, since it's officially king, and you can actually get a reasonable higher rate possibly than currently what risk assets and equities are returning right now, at least for the year to date. And right now, since you officially don't have to earn close to nothing anymore with cash, I'm going through a type of ladder approach, which I can talk about a little bit later, which is similar to dollar cost averaging with my short-term treasuries, T-bills for short, in which I'm buying longer term duration treasuries also at a moderate pace, which usually include notes and bonds and beyond. And since banks have really no real incentive on raising yields for their customers' savings accounts, given that they don't earn a high enough spread on it anyways, especially from trading activity these days, and the higher yield they guarantee, the more costs go to their bottom line, which really entails that tapping into treasuries from T-bills to T-bonds are probably the most prudent and optimal strategy these days, as cash is once again finally king. And as I always say, and I'm going to say it again, even as a 21-year-old, it doesn't sound foolish ever, having roughly 6 to 12 months of living expenses in cash, no matter if you are my age, 21 or 98 years old, having extra liquidity, especially during a recession, is essential to not only be able to stay afloat, but also ultimately sleep well at night. I believe that that's the true meaning of financial freedom and success, that you're able to only depend on yourself, not the Fed or your parents or any of your other loved ones, but solely yourself, and to be able to provide your own living. And more on this topic of just deploying your cash, since majority of risk assets, at least in the public markets, are currently in turmoil, engaging in something called tax loss harvesting, where you sell your losses to protect your gains before year's end. So this would occur roughly November, December, before the new year starts, is a really great strategy to take advantage of as well, to ultimately lower your capital gains tax. If your accountant, CPA hasn't briefed you on that in your portfolio, or your portfolio manager in itself, that's probably a red sign, or a bad sign, since taking advantage of all possible tax incentives and opportunities like this, especially before the new year begins, is a prized opportunity, since after all, taxes are the wealthiest's largest and ongoing liability in life. And sadly, death and taxes are life's certainties. Let's just not think about it. So adopt these strategies instead. Furthermore, speaking of compounding, the latter approach of dollar cost averaging by incrementally investing in tranches is something everyone should be doing to build incremental wealth over time, and that's most favorable nowadays, as the Fed insists on raising the federal funds rate, the FRR, to 4.5-ish, and higher yields are upon us. I have a feeling if earnings start getting cut by roughly 10 to 25% once the Fed announces more hikes, then the S&P could easily decline to 3,200. Curious all of your expectations and predictions, and you can comment down below for that. And in that case, alongside just engaging in dollar cost averaging to take advantage of dips, I'll also be doing this technique called nibbling at these levels, at the bottom of the market, since an average bear market, after all, just lasts roughly a year or two anyways. So I'm confident we'll see the light at the end of the tunnel eventually, sometime in 2023, after I graduate in May. And no matter what, if you're a true investor, you'll be able to weather really any storm if you follow the strategies and tips that I outline constantly about really deploying your cash, staying diversified, and ultimately having at least 5 to 10 passive income streams and paying down debt. Although inflation in that case is luckily doing that for you, with yields higher than mortgage rates at the moment. So therefore, I suggest buying in tranches of roughly, it's all dependent on your time horizon and your needs, but going in tranches of around 1,000 to 5,000 after every 1 to 2% decline or dip in the markets through the end of the year is something that I may be following. And if the S&P 500 somehow goes below 34, 3,500, which banks are somehow expecting, with their pretty bearish forecasts, with over 80% likelihood of a recession in sometime Q1, Q2, 2023, I'll definitely increase my investment size big time, since these deals don't last long with cash drop tech that trade on future expected earnings. And just being able to realize that these tech stocks also are trading at pretty reasonable levels compared to during the pandemic, when it was at 23 times earnings, and now it's back to tech stocks trading at around 16% times their earnings. So now enough about the public markets. Let's discuss untapped golden goose opportunities within the private markets that I've been looking at lately. If you've been keeping up with my findings and analysis these past few years, but specifically in 2022, you probably know by now I'm an avid fan, investor, consumer, fanatic, connoisseur, whatever you want to call me, of real estate, one of the most defensible, not to mention inflationary-proof asset classes that not only provides two sources of income through rising rents and an invaluable, appreciable return through its utility factor and value, and not to mention its physical and tangible qualities, letting inflationary proof investment really work for you, which also lies in private capital market investments such as farmland and artwork with a longer lockup period and more liquidity risk, since you can't tap into that money right away, but definitely a fireproof, defensible way of building wealth over time, which I hope everyone is guided by. And luckily, in this day and age, private market investments, which entail investments that aren't publicly traded outside of the public markets, without catering to shareholders and with less scrutiny and regulations overall compared to publicly listed companies, which have to deal with not only various regulatory constraints such as the SEC, FINRA, and of course the exchange itself that they're listed on, but private markets already have more favorable opportunities, just including in being a non-correlated investment to public equities right now, that offer potentially higher return, also known as alpha, but do come with more beta risk, since they're taking arbitrage and options trading strategies from the managers, specifically within hedge funds and private equity, not to mention just higher management and performance fees overall, specifically within a private equity or farmland type model that are tackled on for these prized investments. And also something to note is that accredited investors who have a net worth of, and please fact check this is something that I've heard, but more or less changes over the years, accredited investor of a net worth above 1 million or an income, that exceeds over 250K per year, and institutional investors, namely pension funds, endowments, and foundations, along with sovereign wealth funds and endowments, college endowments, have the opportunity to invest in these assets, just in an effort to confirm that no retail day trader would invest their life savings in a private unicorn, or also known as a zombie startup. That's a new term that I heard lately, where those are companies that really take advantage of cheap borrowing and get listed simply because of that, as we saw in the speculative frothy market of 2020 to 2021 within the venture capital world in particular. So the private markets include investments in private funds such as private equity, which either have a majority stake in a public company to take them private and restructure them by going through leverage buyouts and M&A restructuring to ultimately sell these companies at a higher price to earn a profit, to net a profit. And private capital is another form of private investing, which loans out money to small companies with higher risks of default, and more likely to possibly go bankrupt, and taking that risk on top of the investor, alongside venture capital, especially been an emerging frothy, no pun intended, really volatile space in the last 2 years with startups and all the talk around SPACs and unicorns, by either taking a majority stake of them through equity and taking them public with these private unicorns. And those are the four main private investments that have been popular. If I'm forgetting one, oh yes, private debt, similar to private equity, just issuing debt to help restructure the public company when taking it private is included. And overall, private markets also offer real assets. Personally, my favorite, as I'm sure you know of, and I just mentioned above, which includes physical, tangible real estate. Also, there are natural resources, infrastructure, farmland, and of course, artwork. And thankfully, in this day and age, in the 21st century, platforms such as Fundrise, to CrowdStreet, and Farm Together, none of them are sponsored, by the way, FYI, have all democratized this market and offer several different asset classes for individual investors. So you don't have to have a top 1% net worth or a FINRA license or manage $1 billion pension fund anymore to be able to tap into these investments and really earn a non-correlated return to your investments. Normally, one would have to invest millions up front in a Van Gogh or Matisse painting, for example, when it comes to artwork. at a Sotheby's auction, let's say, but not anymore with the option to invest shares of paintings, even within the art market. So in sum, having a scoop on what's available for even accredited investors can help you down the road. And just because something may not be available for you as an everyday retail investor today may not mean that it won't be available down the line. It's always important to pay attention to what's outside, even with outside of the US. Tapping into emerging markets may be favorable even down the road. So to better assess your net worth allocation, it's important to create strategic asset allocation, and ultimately to beat the benchmark and seek golden goose opportunities is by tapping into private market investments, especially as the public markets are on shaky ground right now. And being able to weather the storm really means tapping into uncorrelated investments and searching outwards. It's a good feeling to know that the private markets are a pretty much untapped opportunity, certainly not as popularized as the classic index fund and ETF available through the public markets. And it's reassuring also to know that there's more access to these platforms. And in exchange, private equity, venture capitalists, and hedge fund managers get to manage more funds as a result. So we're all happy. There's always a bull market somewhere. And now, just as a heads up, I'm not your financial advisor or money manager, so please invest at your discretion. These are just some of my findings and what I'm looking at specifically. Personal finance is personalized after all, and you have to assess your own risk tolerance, time horizon, short, long-term goals and needs, etc. And tapping into the private markets outside of the public, which have taken a beating heading into this recession, can be an opportunity for more investors that I would suggest just being aware about. So stay tuned for next week, also on this topic on what's happening in this space and whether we're going to unpack whether Q4 is really off to a rocky or reasonable start, and diving into the September effect and what that could really mean and how that could play out for markets in the following weeks into Amazon Prime Day and the holiday season. And as always, not going to force you, but I would really appreciate it. Please like and subscribe, and also let us know your questions, comments, concerns, criticisms on what your thoughts are about the private markets. There's no right or wrong answer, just what you believe would suit you best individually and what you're interested in. And see you all next time.